Hi, I'm Daniela Cambone for StansberryInvestor.com. As Wall Street is digesting rising bond yields, should investors be bracing for more volatility in the stock market? And what will it mean for assets like Bitcoin and gold? Joining me today is Simon Mikhailovich. He is a managing partner of the Bullion Reserve, and he has over 35 years experience in the investment business. Simon, good to see you again. Welcome to Stansberry Investor.
Thank you, Daniela. It's been about 9 years since we last spoke.
9 long years.
That's a long time.
So Simon, very happy to talk with you because you are a wealth of knowledge when it comes to the gold price. So I know our viewers will appreciate your insights here. I know I will. Let's start with major news here of the rising bond yields, levels we haven't seen since last February. What is it indicating to you? Are we on the verge of a red hot economic recovery, or is inflation on the horizon?
I have no idea. I don't have an answer to that, and I don't think anybody does. A lot of people have opinions, but they don't have answers. So I'll just be honest, I don't know. But what I would say is that what that tells me, given the level of debt outstanding and the debt service that would result from higher rates, I would say that the value of gold as insurance is rising, even as its price on the COMEX is falling, which is not an unusual phenomenon. We can talk about similar type of events in other insurance markets. But it makes sense to me. Correlations that are driving these trades have been established since the 1970s. Insurance, the reason insurance is owned by central banks, for example, as a reserve asset, is for insurance purposes. It's credit insurance against sovereign risk, against currency risk. And it's a completely different driver and value proposition than just trading against rates. But the period over which all these correlations have been established have not seen, since the 70s basically, have not seen a sovereign debt crisis in the West. It has not seen a crisis of a major Western currency. And so this is a bit like a catastrophic insurance market that's been trading for 50 years and there hasn't been a claim. And so in the absence of a claim, there's no fear that there will ever be a claim. And so the trading and the dynamic that drives that trading doesn't really have necessarily anything to do with insurance value proposition here. So if we posit for a minute that rising prices posit significant threat to credit quality of a lot, or just existence of a lot of companies that have borrowed heavily and have to service debt at higher rates, then I would say that the chance of a systemic crisis is going up, even as the financial price anyway on the screen of systemic insurance is going down.
Well, we're definitely in a context, if we look at other commodities, copper at an 8-year high, lumber at an extreme high, but investors want to know why the pressure on gold, Simon?
It's a market. There are different markets in gold. There are different players in gold. There are people who buy jewelry. I mean, I'm talking about jewelry manufacturers. There are miners. There are speculators, like in most markets. And all of these people have different ideas and different dynamic. The biggest potential investor here is the Western financial investor, who could be exposed to dramatic depreciation of financial assets in real terms. And, whether it's inflation or deflation, I'm saying in real terms. So, there are two ways to get out of excess debts. You either inflate them away or you just restructure them. So either one of those scenarios destroys real purchasing power of financial assets. And gold has been, for whatever, as far as we can tell in history, has been insurance against that. But nobody had seen that in their professional life. So if you just expand the horizon of what insurance you're buying against, of course, in the last 50 years, it would all be, well, inflation, no inflation, rates are up, rates are down, I can get a better yield on treasuries versus gold. But I mean, think about what that says. I can get a better yield on treasury versus gold. It means default risk is not a concern. It means you're equating the fact that gold has no impairment risk and comparing it to assets that have not had impairment risk in living memory, but in the fullness of time have had plenty of risk. And so it's just a matter of how you look at it. So look, I can give you a very specific example. So please. 2005, 6, 7, 8, 9, right? The Big Short. It's completely misnamed. It's a misnomer. It wasn't a short, it was a long. And the long was that investors were buying mispriced credit default protection on subprime bonds. And that subprime, that protection was being sold for pennies by AIG and all the major Wall Street banks because, as Mr. Bernanke clearly said, real estate prices have never declined prior to that, and they haven't. And so the assumption was that they never would, and therefore insurance was mispriced. So the few people who perceived this breach, this massive difference between real risk and perceived lack of risk in the market, well, we know what happened. History was made in terms of what happened to the price of that insurance and the value of that insurance. I think I'm not speaking to the quantity of potential change. I'm just observing that this is a very similar situation. We're in a sort of insurance market where nobody has made a claim from the dollar-based, currency-based investor or EU or whatever. Well, whatever, since post-World War II, really. And so everybody assumes, just like they did at that time, that that can never happen. Well, if you look at the financials and whatever, everybody can make their own assessments as to what these risks are. But I think enough people see these risks, even though they may not fully feel in their gut the implication of such events. But these risks exist. And so gold reflects lack of concern in the Western investors about these risks. And so it does not embed that premium right now. And we can talk about how that premium gets formed in real events. But it basically doesn't embed that premium. So yes, in the absence of defaults, credit default swaps, which are credit insurance on the company, they fluctuate, go up and down, depending on interest rates, depending on how that industry is doing, a lot of different things. But when there's real credit risk in town, those prices move, and they move dramatically and quickly. And that puts a lot of pressure on the company. And there are a lot of theories that gold has been suppressed. I don't know if it's true or not, but I would say that if gold price were to move sharply and quickly higher, that would put tremendous pressure on major currencies. I'm talking about move in major currency terms, just like it does on the issue of bonds when their credit protection price goes through the roof. Basically, the market loses confidence.
Okay, so obviously a move to the upside. What kind of move? Like a $50 move, a $100 move?
I don't have any idea, but let me describe the dynamic, and then everybody can figure out for themselves what's happening here. So a lot of people who analyze gold are commodity analysts. Gold is not a commodity. It is not produced to be consumed. It is produced to be owned. All of the gold in the world is owned by somebody, except for whatever is on the bottom of the oceans, or we haven't found in the backyards. But everything that's ever been produced that's above ground, somebody owns every ounce of that. Just think about that. Every year, about $200 billion at today's market prices is dug out of the ground and delivered to the market by the miners. Miners are there to sell gold. That $200 billion a year is available at today's price, pretty much at any market price. It was available when gold was $1,000 an ounce, and it will be available, it was worth less, and it would be available at whatever price. Anything beyond that, now $200 billion is not a lot in today's market, at today's prices for annual demand. So think about it. Out of 100% available supply, theoretical available supply, in any given 12-month window, 98.5% has to come from people who already own gold. So demand for physical gold is inversely correlated to confidence in counterparties and currencies. So if people are comfortable with counterparties, they would execute their strategies through paper gold, whatever, LBMA market or COMEX or whatever. And they don't do that. But imagine if you think for a moment that on the other side of that trade from you is a Lehman Brothers that's about to become a Lehman Brothers. Then you don't want IOU, you want physical possession, because gold happens to be the only insurance policy that doesn't have somebody on the other side to pay it out. The policy is itself. So demand for gold in that situation, for physical gold, rises in direct proportion to the erosion of confidence in major currencies and counterparties. Now, it works look at Argentina, Brazil, all these countries where currencies have lost value, Venezuela, whatever. I mean, gold has been in the bull market forever and continues to be. We just haven't seen this in major Western currencies, so we don't think of it in those terms. So now think for a moment that a certain number of investors have developed urgent desire to replace their fiat currency or their financial assets, which now they suspect to them, for a counterparty-free asset store of value like gold. So where do they get it? They have to get it. Well, the first 200 billion, let's say, at today's price, comes from the mining companies. Where's the rest of it come from? So it's people who already own it. So what are the people on the other side of this trade are thinking? They're being asked to give up their insurance in exchange for fiat currency and financial assets. Well, if they're confident in the value of those assets and currencies, they would do that at a reasonable price. What if they're not confident? What if they're as scared as the people who are surging to buy? What is the clearing price in the market at that point? Well, it's like an auction. You show up to buy a Van Gogh, and the hammer goes down, and you bid against whoever's in the room and around the world, and the highest bidder walks away with the painting. And as we have seen with scarce assets like paintings, there have been some highly unexpected outcomes in terms of price appreciation, nominal price appreciation. So I think that gold embeds this incredible insurance asymmetry. You can tell what it is. You can't quantify that in exact amount. But if you understand this dynamic, it's similar to the credit default swaps for subprime mortgages, when it turned out that something that was considered never to no possibility of happening happened. Everything changed. And the same thing would happen to any insurance market after a hurricane or during a hurricane. Where do you get insurance during a hurricane? Who is selling something for a certain loss where they're going to cover for? It's the same thing. Think of the person who needs to sell his gold in the middle of a hurricane. You're asking them to part with their insurance. Like, for how much? Well, there is a price. There's always a price, but it could be maybe very, very high price. I think that's the framework in which I think about gold.
Right.
And it really boils down to risk assessment. If you think that the risk is there, then gold is very cheap. If you think there is no risk, and like everybody thinks there's going to be a massive recovery, modest inflation, well, I don't know that. Maybe then I don't know what the right price is.
And I think I love the point you made on Twitter about how it really comes down to perception. How here in the West we say, when gold is down, we say the gold trade is not working, whereas in Asia they would say, gold is on sale. But getting back to your point, as gold is the ultimate insurance that you hope you never have to cash in. If it's an insurance for you and not necessarily wealth preservation, are you not? Do you not worry about rallies in gold, and you don't need gold to necessarily go to $5,000-$10,000 an ounce?
Nominal price. I mean, I know everybody wants to hear some price targets. I mean, think about it. Do nominal prices really matter? I mean, gold was $35 an ounce, and now it's 78, right, whatever, 1730. Does it buy more? Not necessarily of some things. So nominal prices, I mean, if it goes to $50,000 and bananas are $6 a piece, I mean, did you accrete value or did you lose value? It really very much depends. On the other hand, gold price doesn't need to go anywhere in a deflationary collapse. If everything else goes down by 90%, in the land of the blind, one-eyed man is king. So your purchasing power relative to productive capacities in corporate assets, is just up 10 times. I mean, you can name your price. So I think that you need to think in terms of purchasing power, not in terms of dollars. Right.
But deflationary environment definitely does not seem to be the scenario that's panning out here.
That's what, honestly, if I learned anything in this business, it's like everything is very clear until it all goes pear-shaped. Look at the games, whatever it's called, GameStop. I mean, did anybody know 3 days before it happened or 7 days before it happened that the market could be in such distress on account of some people on Reddit piling into a trade? And then it happened. So I think events are happening with increasing frequency and heightening severity. And I think it's very unwise for people to take very strong positions as to they know what's going to happen. Because honestly, when everybody says we're in uncharted waters. You know what that means? It means we don't know where we are. That's what it means. That's what it literally means. There is no map here. We don't have a map. But if you look at broader history beyond 50 years ago or 60 years ago, there is a map. And it's pretty clear. I mean, the details are always different, but it's pretty clear that situations like this resolve with rebalancing of the books. and the books will be rebalanced. And in this rebalancing, the only asset that doesn't have impairment risk and counterparty risk is physical gold. Now, other assets don't have that risk. I mean, real estate and other land, whatever. They're just not portable or liquid. That's all. Gold just happens to be the only liquid financial asset that's not connected to the system, whether digital system or financial system.
And you're making a very strong case for physical gold. So I have to ask you, if gold is the ultimate insurance for you, how do you view Bitcoin? What's Bitcoin to you?
I don't view Bitcoin that way, because Bitcoin, I sympathize very much with the sentiment of Bitcoin sort of ecology of getting out of the financial system. The problem is the system is not limited to the financial system. The digital networks are part of the system. Governments control significant portions of the internet. And if anybody needs any examples, in the last 6 months alone, people getting deplatformed, businesses getting put out of business by being cut out of specific apps, specific online services, specific infrastructure services, hosting, access to payment rails. I think it's dependent on the digital system. It's dependent on the infrastructure that Bitcoin owners do not control. And we do not have any history with how this works in a major systemic crisis. We just don't. So, safe haven and store of value is something that is understood to be proven or tested or some scientific method. There's a thesis, there's experimentation, and there's the conclusion. Well, we have a thesis with digital assets. We're experimenting, but we don't have the outcome of that experiment yet. So I don't know. I mean, I'm not particularly sanguine about systemic risks in the digital space. And I think we have seen, and by the way, the Homeland Security in the United States and the Defense Department consider cyber risk as the top priority, the top strategic risk. So, putting yourself in the crosshairs of that risk doesn't make me warm and fuzzy. Which is not to say that Bitcoin is a bad idea or doesn't have value or can't go up. We're talking about specific application for this purpose. Right.
Simon, let's just wrap up with your thoughts on gold miners in terms of exposure to gold.
Well, I mean, gold miners, obviously their product that they extract from the ground is gold. So their fortunes are tied to the gold price. But if you look at the valuations at which they trade relative to their earnings and their cash flows, they're value stocks. I mean, whatever you think of gold at the moment, unless gold price goes to whatever, nothing, they're value stocks. And so to the extent we have a stock market debacle and reorganization of the system, one thing we learned from all these experiences is that companies in the real world that produce real products for real people and can be purchased at reasonable prices are one of the better ways to protect value. Of course, they're subject to systemic risk because they're digital shares custodied in the financial system. So I wouldn't call them safe havens. I would call them more investments. But as far as just regular investments, compared to Tesla or whatever that's valued based on some future expectations, which may or may not happen, these are valued well below, what they're worth just in the normal course of business, seems to me.
Simon, final thoughts for investors watching. Yes, we are in uncharted waters. You've said it's dangerous to have strong opinions in times like this, but for investors looking for some guidance here, what would you say?
I would think of tangible assets, not just gold, but tangible assets, collectibles, and other things, as basically safe harbors in this situation. History shows that these times are not about trying to make a fortune. These times are trying to preserve your position so that you have access to liquidity and access to the means to buy cheap assets when other people don't have liquidity and are pressed by circumstances to part with their precious possessions or investments. And so, for me, this is not a time to be a hero. This is a time to position to preserve and protect and see how this plays out. I know this is not a popular view. I know everybody wants return, but you know what? There are times when you should worry about return on your capital, and there are times when you should worry about return of your capital. And I think the time for that is now much more so than for the former.
Very wise. Simon, I appreciate you joining me today here on StansberryInvestor.com. Thank you so much.
Thank you for having me.
And thank you for watching. We'll have much more for you on StansberryInvestor.com. In the meantime, keep following us on all our social media platforms. Thank you for watching. I'm Daniela Cambone.